Okay, thank you all for coming. So far we've been enjoying the micro side of financial markets. Now we will switch gears a little bit. We will focus on the macro aspect of financial markets, mainly focusing on systemic risk and risk management. My name is Turan Bali. I am the Robert Parker Chair Professor of Finance at Georgetown. And it's my great pleasure to introduce our keynote speaker, my co-author today. It is tough to introduce Rob in a short time period, even to summarize his accomplishments. But we are in for a real treat today, I should say. Rob is the 2003 Nobel Prize winner in economics. He has been the driving force behind many path-breaking work in econometrics and financial markets. He published a large number of foundational articles, seminal pieces, and books. Especially two of his articles, maybe out of 200, on co-integration and arch models, received more than 30,000 citations in Google Scholar. That's my count 2 days ago. And his sophisticated statistical models are used frequently in asset allocation, derivative pricing, and risk management. In addition to being a prolific and influential researcher, he has a significant practical side as well. He serves on the advisory boards of financial institutions and government organizations. He spent 25 years at UC San Diego. Since 2000, he has been the Michael Armellino Chair Professor of Management and Financial Services at NYU Stern. So he did all the good work at UC San Diego, and NYU got all the credit. If you are interested in his recent research on financial markets, you should visit his Volatility Institute website, VLab. We published one article together, and we have been working on several projects together. It's a real pleasure working with him, and it's a constant learning process for me. We are truly honored to have him as our keynote speaker and the first distinguished scholar, visiting scholar at Georgetown. Please join me in giving a warm welcome to Rob Engle.
Well, thank you all. It's great to be here. And it's nice to be in this wonderful facility talking about all these important topics in microstructure and the quality of markets. I'd sort of like to step back a little bit. You may remember we had a financial crisis here a couple of years ago. It might be over. We're not totally sure about that. But even if it's pretty much over in the US, it's going strong in Europe. And we really have to worry about whether the financial system in Europe is going to be strong and viable in the future. So when we talk about quality of markets, it's pretty important that we think about the quality of markets in this bigger context, because during the financial crisis, lots of things happened to market quality that are not part of the plan. And so I'm going to take a sort of bigger view. I'm going to show you some work that we're doing at NYU on the financial crisis, and particularly forecasting and discussing the regulatory environment for the financial sector looking forward. So let me, let's see. So I'm going to show you some statistics on something we call S-risk. S-risk, lo and behold, stands for systemic risk, but it's our own measure of the risk that a financial institution poses to the global economy, and it's defined in the following way. If we have another financial crisis going forward, how much capital would this financial institution have to raise? It's a number. It's measured in dollars, actually billions of dollars. And it's this measure that we think is important in understanding where our financial risks are the greatest, and what regulatory response should be made to these risks. So we estimate this measure, and I'll tell you a little bit about it, but not actually too much about actually how we do the estimation, based on market data on equities and accounting data on financial institutions. We do it weekly on VLab and publish this, and I'm going to show you some slide shots that I did yesterday from VLab. So this is up-to-date information on where we see the systemic risk measures going today. We do this for the US and globally. So what's the calculation we're actually going to do for S-risk? It's designed to be the capital that this firm would need to raise conditional on a hypothetical event, which is we have another financial crisis. So it's the expected value of a capital shortfall given the possibility of a future financial crisis. And we define this by assuming that there is a reasonable, sensible financial cushion that every financial institution should hold. It should hold some amount of equity as a proportion of its total assets. And we are using, at the moment, a ratio of 8%. It's different and could be different in different situations, but that gives you a pretty good way of understanding how much capital these institutions do hold. And when we have a financial crisis, this leads to a decline in equity values for the global market as a whole, as well as for each of these financial institutions. And so if their equity goes down, we estimate how much we think the equity of this institution is going to collapse. And since the debt is basically hard to adjust in the short run, it's the market, it's the face value of the debt we think of as the key determinant here, then we'll see whether these institutions need to raise capital in order to continue normal functioning. So it might be clear from this little formula that S-risk depends upon really three features of the institution. It depends on the size. Basically, market cap and equity are both scaled. They're measures of size, and debt are measures of size. It depends on the leverage, that is the debt-equity ratio or the asset-equity ratio, and it depends on the risk, which we measure here by this thing we call long-run marginal expected shortfall. And so that's a measure, that's what we're estimating econometrically, which is the expected decline in equity market cap that this firm would face if we have another financial crisis. So let me just give you a couple of examples here. Bank of America today has a market cap of $102 billion. It has accounting liabilities of $1.9 trillion. That's a big number, right? And so it has a leverage ratio of about 20. So if there's another financial crisis, which we think more or less is something like a 40% decline in global equity markets over the next 6 months. If there's another financial crisis like this, then we would estimate that the Bank of America shares would fall by 66%. So where does that number come from? Well, 40% decline in the global index. What's the beta on Bank of America? It's some number bigger than 1, more or less around 2. What we're really, the econometrics is trying to figure out what is our best estimate of this beta, taking into account downside movements, co-movements of these assets and so forth. And I'm going to show you a lot of pictures. This beta is estimated by something we call dynamic conditional beta, which is a beta that's allowed to change every day and is estimated using information as up-to-date as possible. The beta is actually a little bigger than 2 today, and that's where we get this, this number. But the beta actually is not assumed to be constant over the next 6 months. There are things like mean reversion that we expect to happen in volatilities and correlations, but in a crisis, we see typically betas and volatilities are going up, so these effects all work into the calculation of this 6-month ahead time period. So for Bank of America, the S risk is $122 billion. So you think about what we put into Bank of America before, it's the same sort of order of magnitude. In fact, 8% ratio turns out to be, as you can probably see, a leverage ratio of 12 or 13, so it's actually got a little more leverage than we think would be comfortable today, but in a financial crisis, it's going to need even more capital. Another example is Credit Agricole, which has a market cap of $19 billion and a leverage actually $2.1 trillion. So it has a leverage ratio of 114. It's well underwater in our view because it cannot function as a normal financial intermediary with this small amount of capital compared to its debt. And if the global financial markets collapse, it has a beta which is pretty high, bigger than 3 at this point, so we expect that this capital that's left is going to vanish very quickly. So it's going to need this infusion of capital. So why is this a measure of systemic risk? Well, if we have a financial crisis, then all the firms with positive S risk will simultaneously need to raise capital. If the aggregate S risk is high, there is going to be nobody left to supply this capital. It's hard to raise capital in a crisis. The only source is really taxpayers, and that's why this becomes a financial crisis, because this capital cannot easily be raised in a crisis. It might seem like we have the causality backwards. It looks like the crisis is causing the capital shortfall. But in fact, the crisis causes the capital shortfall, but the capital shortfall causes the crisis. It's jointly determined. And how really do we think this is going to work? Well, what you would expect to happen is what is really happening to Credit Agricole at the moment. They're not making any loans. They're not providing the sort of functions that a financial institution would do. They're not providing the links that the real economy needs. And consequently, the firm will, as it tries to de-lever and de-risk itself, stop providing the services needed. The real economy will start to decline. Investors will reduce the valuations of both the aggregate assets as well as these financial institutions, and S risk will continue to go up. Stock prices will continue to fall. As stock prices fall, we find volatility goes up. As volatility goes up and betas go up, the S risk will go up even more. The needs go more, and we have a sort of a spiral which ends up in bankruptcy for many of these financial institutions until the market is sufficiently collapsed that new capital can be attracted. Now, of course, there is a possibility that taxpayers would jump into this business and prevent the fall. In fact, that's actually why the sovereigns are in trouble in Europe, because they've all agreed that there isn't the same question we have in the US. In Europe, it's pretty clear that every country is going to rescue its own banking sector, even though the banking sector may be much bigger than the sovereign is, and the sovereigns can't afford this. So we call this a sovereign crisis, but in some sense, it's really a banking crisis. And of course, if taxpayers are expected to step in, then we lose market discipline for these financial institutions. We want too big to fail to go away, how are we going to do this? Well, the answer really is universally thought to be wise and effective regulation is about the only solution. So faced with this eventuality, why would any bank ever let itself have positive and high S risk? Well, there are sort of two reasons. One is that its incentives don't necessarily prevent this. For example, if only one firm has high S risk, we don't get the spiral because its declining business can be picked up by its competitors. It's when many firms have high S risk that you see the downward spiral. So there is an externality in the conventional sense. Secondly, there are implicit and explicit government guarantees which protect firms from seeing the risks and lead them to take on more than they otherwise would. We think that the regulatory incentives may also be somewhat perverse. For example, the use of risk-weighted assets as a regulatory criterion may have very misleading ideas as to what's risky, such as mortgage-backed securities and sovereign debt, which are treated as completely riskless in this system. But it also has no benefit to diversification because it does not use correlations between assets as important. So there is no reason why a financial institution from a regulatory point of view wouldn't want to invest most of its assets all in one thing, because that would be a way of reducing its risk-weighted assets even though it doesn't reduce its risk. So those are the regulatory incentives, but of course there's miscalculation, which may very well be an important part too. I think one interesting one is that they might use short-run risk measures to decide on long-run positions, particularly of illiquid assets. They might also be lousy at valuing exotic securities such as CDOs and CDO squareds and all these kinds of things. Or maybe they just didn't think it was possible that housing prices could go down. There are many possibilities for miscalculation. So what kind of regulation are we talking about? Well, here's too big to fail. There's another solution, throw money at it. Here's another solution, keep bailing, or regulate. Please close the gate. So regulation, it's easy to say, yes, let's regulate, but it's hard to figure out how to do this very well. And these are all sort of cartoons about how difficult the regulatory process is likely to be. In the context of S risk, we might suppose that regulators would say something like, banks should have S risk of 0, so that if we have a financial crisis, they have a sufficient cushion. This is just a possible regulatory environment, but it means that these S risk numbers are statements of how much the regulatory agency would require the banks to reduce their S risk. And how do you reduce your S risk? Well, you can delever, you can demerge, that is, get rid of some subsidiaries, you can de-risk, or you can reduce your correlation by not betting on the same thing that everybody else is betting on, so that you're not so correlated with the market as a whole. Any of these things would work well to reduce your S risk, and in fact, by giving the banks a high-level target like this, you allow them to choose the optimal way of reducing this, this criterion. So what do we see when we measure the systemic risk? And these are pictures from the VLab. So I'm mostly going to show you betas. And you could see why the beta is the important kind of calculation. So here's the beta for JP Morgan. And let's see if this has a, let's have a, oh, that was not the right one. Is one of these things a laser? Do you know? Let's try that one. Ah, there we go. Okay. Oh, but now I did something else. Okay. Okay, so here's the whale. When JP Morgan announced its result, what basically happened is stock price went down and its correlation with the market went up. So we got higher betas. So the betas jumped up for a while, but after a little bit, investing population decided this was not such a big disaster, and the beta came back down again. So the beta for JP Morgan is hovering around 1.5. It was lower here. It was higher during the financial crisis, but this is the idea. And so when you calculate the S risk for JP Morgan, it's now about 120 billion. It was a little higher right after the whale was discovered or revealed or whatever. But it was also high last summer when the financial markets went crazy around the renegotiation of the debt ceiling in the US. And it was almost as high as it was at the peak of the financial crisis. So when you look at the US, this is kind of our snapshot of what we see. Bank of America, we have on the top of the list with 122, JP Morgan 108, Citi, MetLife, Morgan Stanley, Goldman, Prudential, Hartford, AIG, and Lincoln National are our top 10 institutions in terms of their systemic risk. And what this really means is which of these institutions would have the biggest impact on the economy if they were to fail. So this is not necessarily a statement that these are bad or rogue firms or anything like that. This means that they're big and important. What do we see if we look in Europe? So here's Deutsche Bank's beta. And you see the financial crisis here. This is September of '08. This is Lehman. Nothing. Nothing happened here. The beta's been about 1.5 sort of for a long period of time until last summer when it went shooting up. Summer of '11 when it was shooting up to about 2.5, and then Draghi made his nice announcement this summer, and it dropped down again. But the markets really are not fully convinced that it's going to stay low. The market caps have gone up, but the risk has gone up as well. Here's BNP Paribas. You see something like a similar story, but betas are a little bit bigger. If you look at Barclays, again, see rising betas all through this period. Here's Credit Agricole. So we've got betas here of 3 or even 3.5 in the recent period. So investors, we're assuming, actually see the weakness and the effects that these firms are, what's going to happen to their stock price if there is a downturn in the global financial markets. And of course, European financial market is a key ingredient in the global financial market. Here's Italy UniCredit. We had at one period a beta of 5 according to this estimate, which is, suggests that and that again was the summer of '11. So that was time when it really looked possible that Italy and Spain were quite close to being forced out of the Eurozone. And so these numbers are really big. And Santander, you see some increase here, but actually Spain doesn't look so risky from this point of view. So here is our list of the top 15 European financial institutions: Deutsche, Barclays, Credit Agricole, PNB, Bank of Scotland, SocGen, ING, Lloyds, UBS, UniCredit, Santander, Credit Suisse, Commerzbank, HSBC, and Natixis. Notice HSBC actually has the biggest market cap of any of them, but because it's got relatively low beta and low leverage, 15, it has a relatively low S risk. So that's kind of the way this works out. All right, so where's the risk? If you look across country, UK seems to have actually the top spot. But interestingly, Japan is second. Then we have France, United States, and China in number 5. Then Germany, Italy, Switzerland, Spain, Netherlands, a lot of European countries. So it's not quite so clear that we only need to think about Europe these days. It looks like the slowdown in China has made the banks look more vulnerable in China. And of course, Japan is still in its middle of its lost decade, but now it's probably 2 decades. So the Japanese banks have a whole lot of debt as well. So there's plenty to worry about here. So what are the implications of this for financial markets quality, the topic of this conference? So we expect market liquidity to drop in a future financial crisis. So if we're going to have another financial crisis, we would expect the quality of the market, that is the liquidity of the market, to go down. Why do we expect that? Well, first of all, we think there's going to be high volatility, and high volatility is typically associated with illiquidity. Maybe surprisingly, but why is that? Well, we would expect things like the bid-ask spreads to be large, and we would expect the price impacts to be high. Certainly, the high volatility we saw during the financial crisis looks like very big price impacts, and so I think illiquidity is really what we're talking about. Financial distress is likely to impact market makers' access to capital and reduce their activity. Who are the market makers? Well, there are many of these same banks. So for one thing, if they're in financial stress, they're not going to be effective market makers. The capital that they lend to the hedge funds and prop desks that are trading is going to be restricted. So it would not be at all surprising to find market makers had reduced presence, high-frequency traders would trade less, and we would see declining liquidity in the market. OTC markets, like CDS, are made liquid by easy interdealer trading. So you find typically that there are many interdealer trades for every end-user trade. And this is actually how positions are spread around among the dealers. But if these dealers are all in the middle of financial distress, it's not clear they're going to be very effective at doing this. And I think actually our discussions about liquidity, looking at high market cap stocks, really miss the point that illiquidity is, as Jim said and many other people, that it's really an issue of small cap stocks and alternative assets. CDS only trades a couple times a day. So this is really low volume trading we're talking about, and to get it done, you've got to have a counterparty. What about these counterparty risks? Those are high counterparty risks are going to be a result of financial distress, and that will further reduce liquidity. And from the point of view of high-frequency traders, I think there's some evidence that they may switch from liquidity supplying strategies to liquidity demanding strategies when volatility gets high. Consequently, you would find that the market is losing some of its key liquidity suppliers when you have this kind of financial stress. So the net effect is pretty serious, but it's made even more serious by the fact that the illiquidity is going to make the financial crisis worse. The financial crisis is made worse by illiquidity in the markets, and the illiquidity in the assets, illiquid assets are at the heart of both the US and the European financial crisis. In the US, it was all these mortgage-backed securities that had no market. It just completely disappeared during the financial crisis. And now we're seeing the sovereign debt market pretty much disappeared in Europe. Even though these were treated as riskless assets by Basel, they became unmarketable assets, which is the ultimate illiquidity. So I think one of the things comes out of this is that the suggestion of moving OTC products as much as possible to central counterparties might actually improve the liquidity of these kinds of swap contracts, but it's going to shift the risks to the central counterparties, and the central counterparties are going to have to be very good about their risk management and may themselves require some taxpayer bailout money, which I personally think is a good use of taxpayer bailout money. Central counterparty would be maybe the first place I would feel comfortable about supporting bailout. Anyway, so this sort of says the financial crisis is an integral part of measuring market quality in kind of a bigger sense. So now my final slide is actually pretty blank, but let's see if we can make this thing work here.
From the makers of Rage X comes Contagion X. If you think you've been exposed to contagious sovereign infection, Contagion X is for you. Sovereign transmitted debts don't have to be embarrassing or keep you from other financial relationships. You can stay on top by protecting yourself with Contagion X. Rest easy, even if you've engaged in risky foreign exchange swaps or been with numerous indebted foreign partners. Contagion X works by releasing a powerful dose of austerity on troublesome workers, reducing your risk of financial infection so your wealth can be preserved. Ask your central banker if Contagion X is right for you. Contagion X is most effective when used 100% of the time on the other 99%. In certain cases, Contagion X has resulted in riots, defaults, fallen governments, and civil unrest. Unemployment, recession, and economic impotence are likely to occur with the use of Contagion X. In German clinical trials, some bankers have experienced delusions and hallucinations, and in some extreme cases, Contagion X may destroy the very monetary union it is attempting to save. If you're a Wall Street bank exposed to European banks who are exposed to infected nations who are exposed to Wall Street banks, Contagion X is for you. Contagion X. Just because it's your fault doesn't mean others can't suffer for you.
Available at central banks everywhere.
Thank you.